admitting all, yeah? So we've got 23, I think, at the moment. So let's have a look. Admit all. Admit everyone. There we go. Good morning, Stephen. Good morning, Barry.
Morning.
Morning.
Morning, Chris. Morning, Andrew. Morning, Podreg. Thanks for joining this morning's coffee morning. If you've just joined, if you could mute, please, just to cut out any background noise, that'd be fantastic. Morning, Charles. Morning, John. Morning, Hillary. Morning, Bryn. Who else we got? There we go. We'll give it another minute or two, just admitting. If you've just joined, if you could mute, please, that'd be great. Chris, if you could mute, thanks very much. And I think Bryn, if you could mute as well, that would be great. Thank you. Perfect. Thank you. Some more people joining. 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 Okay. Right. It's now 10:32. Let's just make sure that other people. Yeah, that's good. Brilliant. Okay. Right. Well, good morning, everybody. Welcome to the coffee morning, Pension Paper and Coffee Morning. We're delighted to have Russell Lee and Gabani Swanee from M&G, ably assisted by their glamorous assistant, John Quinn-Livin. We hope you enjoyed today's session. I think it's always good to talk about new and innovative products. Before we start, in the usual fashion, we are being recorded. So can we have a thumbs up from everybody that everybody's being happy to be recorded? Thank you very much indeed. And as usual, if you want to put any comments in the chat, please do. Or if you'd like to raise a hand and make a point or challenge, then please raise a hand at any point. And as usual, we'll have our Q&A at the end. But I'll now pass on to Russell. Over to you and Gabani. And I know you've got some slides in me, but if you'd like to introduce yourselves first, that'd be great.
Yeah, thanks very much, Steve. Morning, everyone. Yeah, so I'm Russell Lee. I head up Insurance Solutions here within M&G, and specifically Gabani, I said what's called the Corporate Risk and Investment Solutions area. So that's the area within M&G, sort of bridges the asset management and the life insurer. So within my team, I have people who've been responsible for the first couple of deals in the bulk annuity space that we've executed this year, but also some of the new products under Gabani, and also just a more general interest in that space.
You've your vocals dropped out, Russell. So
Muted.
we can't hear you. Russell, do you want to maybe use your machine instead of the? Yeah.
A high risk of getting an echo.
That's better. No, that's good. We can
Better?
hear you now.
Is it
That's
okay?
good. Yep, that's better. Yeah.
Fine.
One at a time. One volume at a time. I think one mic at a time. That'd be good. So, anyway, sorry. Repeat that last sentence, please. Thanks.
Yeah, sure. So Gabani and I sit in the Corporate Risk and Investment Solutions team here at M&G, and that sits in the area between pure asset management and pure life insurance, but covers, for example, bulk annuities. People in my team responsible for our re-entry into the market there, but also particularly for today's discussion, other areas where we want to see if we can bring some insurance technology to bear as well as asset management. So we don't get pure asset management, we don't get pure risk transfer. We try and see if there's something interesting in the middle where we can help pension schemes along their journey. So that's me. I have a background in pension risk transfer and also a bit of consulting back in the day. Gabani, shall I pass to you?
Hi, I'm Gabani Swanee. There's a lot of echo.
That's a lot of echo, Gabani. You might need to use Russell's machine, maybe. I don't know.
Probably.
Ooh, there we go. The joys of 3 people in a room and Microsoft Teams.
You speak there, and then I'm sure it'll pick you up.
No, we can't hear you, Gabani. We can't hear you. Sorry.
Solution to
Take this out of the echoes, you think?
Right, I'm just going to get rid of that. Can you hear me now?
Yes, that's perfect. Thank you.
Excellent. Right, so my name is. Do you want to mute yourself? Sorry. Test. Excellent. Okay, works. Great, got there in the end. My name's Gurbani Swanee. I'm an actuary by background. I started off my career at the old KPMG M&A team. So started off as a pensions consultant, M&A consultant, and then moved into investment consultancy, fiduciary management. And before I joined Russell as part of the Chris team, I was heading investment strategy at TPT, the DB Master Trust, for over 50 plus schemes. My main focus, as Russell says, is sort of bringing risk transfer solutions that are quite unique. They're mostly focused on balance sheet solutions.
Yes, it's only for me. Can you hear me?
Yep, we can hear you. Yep.
Can you hear me? Yeah, okay, fine. John Quinlan. So I think I'm an actuary by birth sometimes, so my friends say to me, you've got a nickname called Numbers, it's a dangerous thing. So Mercer's for 10 years and Aegon for 20, and now working for a advisory firm in the UK called Cooperstein Capital, advising primarily insurers on innovative solutions in the pension risk transfer market. And one of those that I've been working with is M&G.
Thanks, John. Should we bring up the slides, Gurbani? Yeah, so today's title, if you like, for discussion is, don't give it all away. And if we go into slide 2, then we've got a more specific question. So how do you reduce risk while retaining upside? And I think in order to really answer that, we need to define 2 things. What do we mean by risk and what do we mean by upside in this context? So I think risk here is overall scheme risk. It's not just the investment risk in the scheme. It's also the longevity, the demographic risk, your liquidity risk, I guess, to the extent it's not taken care of on the investment side, and also covenant risk. So that's what we mean. We want to reduce those overall lists in a holistic way. And then upside, well, upside could be upside for the sponsor, could be upside for the scheme. But essentially that is pure investment upside. There's not a lot of upside otherwise. So it's kind of, you could rephrase the question, say, how do we holistically reduce scheme risks for the scheme and for members while maintaining a healthy level of investment return on the scheme's assets? So that's specifically what we're going to try and look at. And with that in mind, I'll hand straight back over to Gurbani again.
Thank you. As per Russell's point, I think one of the instruments that's been considered a lot in the past when looking at not giving up all the upside, and that can be from the point of view of the trustee, point of view of the sponsor. So we're considering the whole range of stakeholders, if you like, is contingent assets or escrow arrangements. And these are arrangements whereby money or assets sit outside of the pension scheme, be it for any sort of covenant enhancement or some sort of negotiation strategy, investment strategy, and there's a whole host of lists why you might consider such an arrangement. The obvious one is clearly avoiding the issue of trapped surplus. Now, depending on which one of these instruments you consider, and these have been things like the pension funding partnership, the contingent asset reserve, the Scottish limited partnerships, reservoir trusts, you also have other benefits of these instruments, such as some of them will give you beneficial accounting treatment. Some of them will give you the sponsor, beneficial tax treatment on contributions that actually do make it into the pension scheme. One solution that we have just launched is called the additional funding solution. And what this does differently, besides taking all of the boxes that I talked about, so gives the sponsor beneficial tax treatment in that the volatility does not impact the sponsor's balance sheet. It gives beneficial treatment to the contributions that ultimately do make it inside the pension scheme, is that it also allows investment freedoms. And the way it does that is this structure is essentially a bare trust structure that sits over an investment platform. And within that investment platform, it gives the trustees, the sponsor, the ability to invest those contributions in a whole range of underlying institutional funds. Now, whether you want to keep that on risk or off risk and provide a bit of diversification to the underlying strategy of the scheme, you could also use that as an opportunity to fund for discretionary benefits outside of the pension scheme. But really, I look at it as having a threefold application. So you can look at it in terms of having it as an add-on for buyout. So part of your journey planning, here's some money that sits outside of the pension scheme that's invested in underlying assets. Again, it can be on risk or off risk, and you can set up certain triggers which dictate the rules for which the money can go back to the pension scheme or the sponsor. You can have it as part of an M&A deal, to enhance covenant for trustees, or you can have it now, and increasingly so given what's happened last year because of the gilt volatility, where pension schemes are increasingly finding themselves well funded. And I use that with quotation marks for a lot of reasons. I mean, what does well funded mean? As part of evaluation negotiations, and you can use it to have risk outside of the pension scheme, or you can de-risk. You can have risk inside of the pension scheme and have this buffer that sits outside that then dictates rules for how money is distributed back to the sponsor and back to the pension scheme. With that, I think I was going to pass back to Russell to talk about the second of these solutions on the on-balance sheet path capital back journey plan.
Thanks, Gurbani, and maybe just kind of one quick comment, I suppose, in this you tie back to the theme, because we're covering various different things you could do at different stages of a scheme's journey plan. And here, I guess, the contingent asset one is, as contingent assets have been for a while, some covenant de-risking. So kind of mitigating the risk that the pension scheme sponsor fails, and there's some extra money available in those circumstances, and the exchange being, as quite often the case, more covenant protection now in exchange for the scheme being more comfortable running a slightly higher level of investment risk for longer. We used to say, when I was at Mercer, used to kind of laugh on the trustee side, like, there's no such thing as trapped surplus. You just use it to de-risk the assets. But that was a good 15 years ago, and things have changed quite substantially, and schemes are much better funded than they used to be. So we move on to the next slide. So this is looking, yes, we have a variant of this, but this is looking maybe in a more general way at capital back journey plans. And I guess, whenever we think about capital back journey plans, we think about what we're developing there. We think about what else is in the market. I guess we've got a list of key questions we'd like to throw out there and sort of, for people to ponder, as it were. So we've got one is, well, what about regret risk? Quite often these involve, someone taking essentially all of the scheme's assets or a large portion of them for a period of time, and there's no way back. So the potential for regret risk, it could be quite high. The next one is, what are you giving up in order to get, right? So you're giving up some upside, you're giving up control maybe of the asset strategy in terms of, in order to get some downside protection. So again, that ticks the box of the theme today, which is, okay, well, in theory, we're de-risking. We're kind of removing some of the downside risk in exchange for sharing some of the scheme, having reinvest the asset in a different way, sharing some of that upside with someone else, holding on to some of the upside, but also sharing the rest. And the last one, when I think about all of these things, it's alignment of interest. What if things start to go wrong? Okay, because quite often capital back journey plans have a limited amount of capital available. And so, from nearly an agency, so risk perspective, if things start to go bad, there's less and less capital available. What's to stop people just putting it all on black? Right, so kind of that's the lens that I like to see things through. And then if we look across this spectrum, again, we've capital back journey plans here. I think it's helpful if you kind of nearly start by saying, well, a buy-in is a capital back journey plan. It's kind of like, it's the extreme version of that, where all the downside is protected by the annuity rider and all the upside goes to the annuity rider as well. It's optimized to give kind of the scheme the cheapest possible price because it's competitive in the market, and then it's optimized to achieve a return on capital for the buy-in provider. But again, whenever I look at these things, it's always helpful, I feel, to understand better what a buyout provider is doing. And so if we look and we say, well, what's the pie? How much is the total upside that's available to the buy-in provider? How much is the scheme getting? How much is going to the buy-in? Because it helps us set and compare against other alternatives. So in this case, for a buy-in provider where they're providing a sort of, if it's a full scheme buy-in, that's got a price of around gilts plus 25 basis points in a discount rate, and they're investing assets that might be gilts plus 125 or 150. After all the cost of reinsurance, the cost of downgrades and decalls, the admin costs, there's probably about 40 or 50 basis points left for the buy-in provider. Out of the kind of, it's a low risk strategy, it's all corporate bonds, and they take on an annual basis, they're probably taking kind of 30 or 40 basis points at risk in terms of it. It will vary by market conditions. Maybe some people might find amazing assets and they can give a good price while still having more upside in it, but there's not much you can do. It's ultimately, it's fixed income, it's credit, it's investment grade. So if you move away from that, and if you're a capital back journey plan where maybe the scheme's investing now in assets that are not investment grade, that are generating well in excess of kind of gilts plus 150 basis points, I think you really want to look at it and say, kind of, is the scheme getting a fair share of the upside there? So it's not just about kind of whether you're getting it or not, it's about how much the other people are taking out and kind of, is that fair? So I think if you try and get somewhere in between this sort of, full buy-in and all the assets sitting in the scheme's balance sheet with no protection, then you have to tweak in some way the sort of the buy-in model. So you can either say, well, I'm willing to accept less downside protection, not full, or I'm willing to accept something where it's not full in terms of longevity, but might be all of the investment risk, or else you have to re-risk up the investment strategy. Or lastly, you have to be able to provide maybe a capital provider, okay, the person backing it who has a lower cost of capital than a standard shareholder-backed annuity fund. So those feel like the choices: risking up the assets, reducing the level of protection, or else finding another capital provider that's a bit cheaper than the normal shareholder-backed annuities. Gurbani, I think that's me. Back to you again.
With that then, Russell talked a lot about the upside, and I think I'm going to concentrate a little bit more on the downside and compare, say, a DIY strategy with, say, an ideal capital back journey plan, and then sort of bring in the solution that we're working on. With an ideal capital back journey plan, if you think about it, if you have, assuming you've sort of assessed it properly and you have the right amount of capital buffer, you would expect it to smooth the volatility and increase the likelihood of you getting to your end game. However, because you're going for a higher risk strategy, you're also then exposed to more of the tail risk. And then the key question comes down that you come down to is what happens when things go horribly wrong, right? In a DIY strategy, well, trustees can just batten down the hatches, right? You could just de-risk and sit and wait and see what happens. Arguably, with a capital back journey plan, it's really important to see what the small print says and what it is that the trustees are signing up to. So, for example, say you've got a capital buffer, things have gone horribly wrong, you're in a tail risk event. Well, what incentive does the capital provider have to batten down the hatches? If they're reasonably certain they're going to lose the capital buffer anyway, wouldn't they just go for a high risk strategy? So, who has the downside here? And that's, again, is the key question to ask. Whereas if you come to an insurer-backed journey plan, and this is something that we're working on and we'll be able to launch and write next year, is, the underlying investment strategy is based according to the matching adjustment rules that are, prescribed by the PRA. This product is overseen by the FCA, and I'll talk a little bit more about how this product works in the next page. And then the other question, as Russell was alluding to earlier, is around upside sharing potential. Who gets the maximum, who gets the biggest piece of the pie, if you like. So if I switch on to the next page, and this is the product that we're working on. We have a very well capitalized with profits fund. Essentially, this is a with profits policy, whereby for initial upfront premium, the insurer provides you with a guaranteed set of cash flows. Now, there's no longevity protection on these cash flows, so you can think of it as an interest rate hedge, limited inflation hedging, depending on the kind of benefits that the scheme has. And in exchange for that, the policyholder, in this case, the scheme, gets to keep 90% of the upside, and that's the solution that we're working on at the moment. And it's quite an interesting product because, having worked on the other side, on the actuarial side of things for a long time, and I know dynamic discount rate is something that had gained a lot of momentum back in the day, and it's gaining a lot of momentum now as well. This is one of these products that lends itself to having a dynamic discount rate. And if you consider this product as part of a wider asset allocation strategy, you can think of it as a gilt replacement trade. And we've all been talking about having a replacement for gilt, gilts, what happens to the upside. We've been looking at LDI. I think this is one of those products that will tick all of those boxes. Russell, have I missed anything?
I don't think so. I think probably it's important here to say this is, again, for people, some people know about with profit, some don't. With profits fund is essentially a not-for-profit type of sub fund within an insurance company. It acts for the benefit of policyholders. So it's not there to generate an enormous return for the shareholders. Shareholders, as Gurbani said, sort of take 10% of the upside. So there is alignment of interest in terms of wanting the assets to perform well, but this is fundamentally acting for you with the upside retained and benefiting the policyholders. So that, I guess, what we've been working on within M&G is, in terms of the list of things that I give out to start with, it's nearly, you could call it if it's a pension scheme sitting in gilts is probably not the lowest overall risk strategy, because there's no carry, there's nothing to protect you from longevity trending against you. So here it is allowing a pension scheme to comfortably re-risk perhaps out of gilts into longer dated credit, matching cash flows, not having geared LDI sitting on top of that, acting and investing we call properly like an insurer, exactly like we would do for the assets then, or if we were taking these liabilities on directly from a shareholder perspective. So that's important to get into this. What are we allowing here? We're allowing a risking to an insurer level of risk, if you like, or annuity rider, corporate bond level, investment grade, that sort of spread and returns that I talked about right at the start, maybe at the minute around gilts plus 150, not absolutely shooting the lights out. The sort of strategy, the scheme itself would probably be comfortable running, but it would be for a lot of people a re-risking, and it would have potential downside for them. So we're allowing that sort of re-risking while the scheme itself benefits from most of the additional return that's being generated by that re-risking. So that's just to be very specific around what's the investment strategy look like, what's the motivation. It's a with profit, as in acting for the policyholders, but you're benefiting from the insurance regime because all of that sits within a PRA, Solvency II regulated insurer. Gurbani, we can probably move on to the next slide. Here, I think, I think it was a comparison. So it's Gurbani did the slide and then has asked me to talk to it. It's always a risk that I cock it up. So I think here, what are we looking at? We're looking again, it's good to have buy-in in a list because it gives you like a standard that's reasonably well understood to compare against. We can then compare against DIY, and we can say, well, I can fine understand there. I take the exact same asset strategy as an annuity writer and run it myself. And how does that look on my pension scheme balance sheet? And then we've got in the middle capital back journey plan and insurance back journey plan. And we're just doing what were our key messages from the discussion earlier? Who's sharing how much of the pie is there? What's the total upside? How much of it is going to the person providing the capital, whether that's the annuity rider or the capital back journey plan or the insurance back journey plan? What's their incentive? What's their motivation? And how does it look in terms of covenant enhancement and covenant protection? What is it doing? Is it nearly a market value upside, or is it actually generating cash flows? What does the underlying strategy look like in terms of, just look insurance like? Is it generating what you expect? Doing what you'd expect? Is it for the scheme, the whole scheme, part of the scheme? What about this thing that we talked about right at the start in terms of what about regret risk? What if you get halfway through and you get a phone call from Rothsay and they say, we can buy you out now. And you say, oh, damn, I've given away all my assets to someone and I can't get them back for the next 10 years. Okay, so does the strategy allow you to surrender? Does it allow you to exit? Have you given away all the nearly control over the assets for an extended period of time? And then the last one is, what's covered? Right, so you can cover a bit of investment returns, you can guarantee some return, but are you also delivering inflation and interest rate hedges as part of that? Because one of the things we did read an article in collaboration with the FT recently, I think it was, and we talked about, look, pension schemes are really well funded, lots of them are really well funded. They have a step change in funding. Do they need to rush for the exit in terms of moving to buy-in or buying it? We said, no, they don't. They have time, but don't panic. Don't sell all your illiquid assets at huge haircuts, but do lock down the risks and do align to buy-in prices while you wait. So again, some of the strategies here allow you to align to what buy-in pricing will look like. And the insure back journey plan that we have will align very well to that, because you're buying the same sort of assets that an insurance company will want to take. And we're trying to structure it in a way that you can just take those assets, and if someone gives you a call for buying, you can move away from us, take all the underlying assets and give them straight to someone else if you so choose. So kind of that, a lot of this kind of think around kind of flexibility, regret risk, what's being delivered, and kind of is it sort of, I guess, is it safe? Are you being reasonably well rewarded for the additional risk that the scheme is now taking? I think I had one more slide as well, which is going to be very short, and just to kind of sort of, I think the summary here is there are a number of providers in the market. We've focused here in the buy-in and buy-out market. M&G is back in that market, and we're also looking to deploy all the technology and the asset strategies and all the things that come with buy-ins. We're really happy to share those with pension schemes, and allow them to construct solutions that work for them. So we're not kind of, if you like, in that sense, selfishly wanting to hold all the assets or just run this where we take all the upside. And we're really happy to work as an asset manager, managing assets, and an insurer at the same time. John, I think I'm probably passing to you for your little slot. Is that right? Or do we want to do questions, kind of?
JQ, do you want to do your slot now, and then we'll do some questions afterwards, or you'll have to unmute, John.
You happy, John? Come on, he's sharing the screen. Oh, come on, John. Go. Perfect. Thank you, Kobani. So if you pop down one more slide, please. The don't give it away message is something that's emerged, I guess, in the last 12 to 18 months. And at the top there, you'll see that I've mentioned Tinbergen. Some of you may or may not know who Jan Tinbergen was. He was an eminent Dutch economist. I didn't know who he was till about 5 years ago when Con Keating on one of these calls mentioned him. So I scrabbled away and had a quick look, and I came across this Tinbergen rule, which I found really interesting. Well, I did anyway. So it basically says the number of distinct goals cannot exceed the number of instruments. And so in our world, in the pensions and insurance world, what that means is if you've got differing objectives between two parties, sponsor and trustees, for example, and then you cannot meet those differing objectives with one solution. That makes a lot of sense. And so frankly, the only way of obeying those principles, those rules, is if you have some sort, well, one way of doing it is if you have some sort of contingent funding, which Kobani's mentioned, or contingent value, contingent capital. And so if you look at the left-hand side, the question for funding, trustees want security, sponsors don't want to fund unnecessarily, but still want to provide security. The way to do it is using a contingent funding vehicle. Or trustees and sponsors have different views on the investment risk that should be taken within the scheme, again, using a contingent vehicle. And on the right-hand side, I mentioned the end game. Clearly, many trustees, many schemes have been aiming, understandably, for the gold standard of buyout over the last 10 to 15 years. But in more recent times, we're hearing a lot of messages about don't give it away. And the question on that in that sense is, what is it? Is it economic? Is it accounting? Is it influence? Is it discretionary increases? And how can you both get a buyout and not give it away? And there are ways that can be done. And they're emerging bit by bit, and I think they're going to emerge quite significantly in the next 12 months. M&G are working on some solutions in that space, and so is another insurer that I'm working with. So Kobani, if you can move on one slide, please. So what have we heard in the last, I guess, 12 to 18 months? Generally, the messages have been, we want certainty, and these messages have come from schemes and those that are looking at buy-in. We want certainty, they want influence, flexibility, they want to settle, and they want transparency and fairness. And that makes a lot of sense. It's very difficult to get all of those in some of the traditional transactions, because the traditional transactions are naturally often more of an arm wrestle when it comes to settling than they are a handshake. And so what we've seen is the development of solutions which have the best of captives, i.e. influence, the best of a mutual, i.e. sharing in the upside, and the best of proprietary, i.e. settling liabilities. And in our view, from the conversations I've seen, we think that some of these new ways of looking at pension risk transfer are going to help deal with some of the significant challenges of both the liquid assets, economic value, the accounting challenges, complex benefits and prudence, multi-employer schemes, multi-schemes of the same employer. And they're going to do that because effectively capital is sitting on the same side of the table as the annuitant stroke trustee stroke sponsor, depending on who the stakeholders are. And it's a different way of looking at insurance, but using all the normal Solvency II stroke FSCS protections. And we think they will emerge in the next 12 months for some of the larger cases in particular, and some of the more sophisticated clients. That's a more of a philosophical look at, I guess, what's going on rather than the technical product end. But I don't know if there are any questions at this moment in time.
Well, if you obviously fantastic presentation, Russell and Gubani, thank you. If you'd like to raise a hand and ask a question
Absolute
of
silence.
any of the presenters, then please do.
Steve,
Stephen Glover's got a question.
Can I hand back to you?
You can, yeah. So Stephen Glover, you got your hand raised. Let's start with you.
Yes, I do. Can you hear me?
We can.
Yes, very good. Hi,
Stephen
Russell
Glover's
and
on mute.
team. Am I on mute? No, you can hear me. Good. John just mentioned the sort of philosophical, but I'm very interested in the real world.
It's funny. It looks like Stephen isn't on mute, but we can't hear him.
I can hear him. So yeah. So Stephen, I can hear you. Yep. So
yes,
you can hear him. Yep.
Okay, but everyone can hear me apart from the person I'm directing the question to, it would appear.
There you go. So yeah,
anyway, maybe you can interpret for me, Steve, and we'll see how much gets lost in translation.
Okay. What's the point? What's the question?
I'm interested in Russell and team's view on how the overall DB landscape is or maybe changing. So the government's productive finance agenda is effectively encouraging DB schemes to run on rather than accelerate their de-risking journeys, which is what obviously the better funding positions would strongly imply. How do you see this playing out in the real world? In particular, do you see more employers not rushing quite so readily into buyout? That's effectively my question. We heard at our recent conference that smaller employers in particular can't wait to get the pension schemes off their books and so on. So I'm very interested to see how to learn from Russell how and team how you actually see this playing out right now.
Thanks, Stephen. So we're certainly seeing a good. Where are we at this point? I think we're seeing the debate, aren't we? We're hearing the government say one thing, but yet we have a set of pension regulations, which makes it very difficult, I think, for a trustee. So, for example, what's the point in a scheme running on if it's completely de-risked into gilts? Right? There's not a lot of economic upside. So what really you want to do is encourage people to invest in a sensible way to try and provide some kind of capital into the economy while not taking undue risk. So kind of what the responsibility is to ensure members get paid. That's the first one. I think it's very difficult to square that with a substantial re-risking of investment strategy. Given that I think pension trustees can probably get fined or go to jail. So if you're in the position where you can afford to buy out, right, and you then at that point choose not to do it and choose to run on and re-risk your pension scheme, and then if everything goes wrong, in a highly correlated way with your sponsor also defaulting, then what are you going to say to your members, and what are you going to say to the parliamentary committee that looks at things at that point in time? So that's the challenge. How do you ensure, having got to that point, that the scheme does not move away from that point? at a later date. Okay, so again, I think one of the elements that I can't remember if I said it publicly or not. It's sort of insurance companies are doing something reasonably economically useful with the assets. Particularly if a pension scheme is sitting in gilts, as we talked about earlier, insurers will sell all those gilts instantly and kind of buy a lot of kind of corporate credit that is providing at least some financing to the real world. I think here the challenge is, how do you make it a bit safer for a pension scheme to take a little bit more investment risk, knowing that they still are not in danger of things dipping at a really unfortunate time. We can probably get on to solutions in that space, but do we think that people are going to rush to do that? No, not. I think without a lot of debate and without some creativity in the market and things like John talked about, having some capital to provide that downside. So I think in the sense of what's covering your, sorry, I'm slightly rude. What's covering your ass, right? If things go wrong. Right, you've reached the point where you can afford buyout. Are you going to kind of then put on a 10% VAR on top of that? So you've a 1 in 20 year risk of being 10% underfunded on a buyout basis. That's really difficult, I think. Why would you as a trustee do that and take that level of risk? Just because the government would like you to kind of invest in a few more private equity investments. I think it's a very difficult ask without sort of a little bit more of creative thinking or innovation around how you deliver a solution like that. That's my personal view.
Just to add to that as well, and I think Stephen, you made the point earlier. I think the debate's quite different when it comes to big schemes versus small schemes. I think for small schemes, it will always be a point around economies of scale and the costs of continuing to run a pension scheme. Small schemes will never be able to afford, at least from what I've seen so far, the discussions that I've had with small scheme trustees, the idea of being able to afford to re-risk towards some of the things that the government guidance is pointing towards is almost far too risky. And they're very much focused on getting to that journey plan to buyout and getting there. Whereas I think bigger schemes, if I talk about some of the multi-billion-pound pension schemes in the market, they do have a little bit of buffer within their investment strategy to potentially allocate towards these risque investments, if you like. So I think that discussion is probably more pointed towards the bigger schemes as opposed to the smaller schemes. Personally, I don't see the landscape for smaller schemes changing as much.
Do you see any schemes sort of coming back from the brink, as it were? Those who would have been heading to buy otherwise, who were on the fence and changing their minds and persuaded that they can be better off keeping on a sort of longer journey plan.
So I think the schemes in particular, the conversations I've had, are the ones that were well funded, with thinking buyout was the only option. But then the issue of obviously inflation and their paternalistic desire towards their members when it comes to inflation, thinking about discretionary pension increases, I think that's what sort of made them rethink their strategy.
I think early this year we were seeing pension schemes really running for the exit. There was a flurry of selling illiquid assets, and kind of not quite at any price, but near enough at any price in order to be able to kind of achieve buyout. People had a step change in funding. Some people are close to the exit, as you say, Stephen, were maybe moved from being 99% funded to say 105. At that point, there's absolutely no need to panic. There's a lot of economic value there, and I have to say, I do feel that some people earlier this year were destroying some of that value by selling illiquid assets at deep discounts so they could quickly get to the exit in terms of the buyout. I think as a trend in the market, we're seeing a bit less of that, which is, in my view, again, the way that it should be. Having sponsors having put a lot of money, pension schemes having carefully managed those assets, I don't see the sense in selling illiquid assets at a deep discount. There's if you've hedged your interest rate risk, I don't see that buyout pricing is suddenly going to kind of fall off a cliff. I think there's enough demand and supply to ensure that kind of pricing remains competitive. And as long as you've hedged your interest rate risk now, I do think that people have kind of become a bit more sanguine around, well, look, there's no panic. We can afford and give it a couple of years. Kind of with funding levels, you think about buying pricing, it gets cheaper as your duration shortens. Okay, and you create economic value for either your members or your sponsor by return of surplus or enhancing members' benefits by frankly not panicking and just locking down some of the key risks that a pension scheme has and giving yourself a bit of time. And let's face it, buy-in providers are so busy. you're not be able to kind of get quickly to the exit if your data is not cleaned, all of those things. So I guess you're kind of, what are we saying? Lots of debate in this area, which is great. Schemes can be a bit more sensible, I think, in terms of understanding that rates are up, they can hedge that risk, they can lock in the buy-in price, but they don't need to rush for the exit. Therefore, they don't need to destroy economic value at this point in time.
Okay, thanks for your question there, Stephen. That's good. Got a number of actuaries and investment consultants on this call. In fact, Chris, you read my mind. I was going to come to you. Chris, you've raised a hand. Would you like to make your point or ask a question?
Thanks, Steve. Yeah, it's really interesting. Thanks all for the presentation. You mentioned about enhancing member benefits there. Were you specifically talking about the DB scheme member benefits, or if you've got a closed DB scheme with an open DC scheme, is it possible to enhance the benefits for those currently accruing members who haven't got the luxury of a gold-plated DB pension going forward?
That's a great question. At the risk of me kind of speaking too much as an Irish person, as we're prone to, then kind of we have a client like that very much at the minute that we're in discussion with, where kind of joint DB DC trust, and there the question is how do you make things a bit more fair? Okay, so how do you kind of with knowing that the DB benefits are just superior, right? There's more funding, but kind of the sense is that DB portion is overfunded. So how do you it comes maybe a little bit to the whole general question of kind of, how can you re-risk and create some economic value? In this case here, how do you kind of sufficiently lock down the DB risk so that you can be confident that there is surplus, and then you can use that surplus then for DC. So I think that's a really interesting problem. That feels like it's a direct read across from the government saying, look, trustees, we want you to take some of your assets, your surplus, and risk them up again. Well, how do we define surplus to start with, and how locked down does the risk have to be so you know that it will continue to be surplus, as opposed to be at risk of kind of funding dropping and then you wish you hadn't done it. So yes, that is certainly a thing that's of relevance, I think, to probably a reasonable number of schemes. I was going to pass it over to John, because I think, John, you're probably working and
Well, it's a great question, Chris. There's some interesting solutions that emerge when the DB and DC excess capital and DB runs off, because that can potentially be used to provide some longevity protection for people in DC as well. So it can potentially help solve the challenge of how the DC members manage their situation post-retirement in that retirement decumulation space, because the profile of the excess capital running off is very similar to the longevity challenge that in terms of shape that the DC members face. And that's to come. I think that's not today's solution. Today's solution is make sure people don't give it all away, but recognizing that tomorrow's solution can use that for DC, without a doubt.
Cool, thank you. I did have another question, but I don't know if I'm allowed to. But it was related to Gabani's point about smaller schemes not necessarily looking for this. I mean, have you got a kind of a sort of a size of scheme that you think this would work well for, that would work well above and not below, effectively?
Generally, in this space, I think anything below 250 million is too small. That's both from an economics perspective, but also potentially the capability of decision makers to get their arms around some of these concepts. And certainly, when you're getting into the £1 billion markets, it's the ability to do certain interesting things increases significantly, obviously. I mean, the theory would be that in time, smaller schemes could aggregate, but I don't see that emerging. Other than for those of the same employer, I don't see that emerging anytime soon. So I
mean, at the risk of plugging the solutions by the Chris team, we will be working on a pooled product for the insurer-backed journey plan. We're hoping back end of next year, the year after, where it is just to do with the smaller schemes, because we understand that it's a huge market there and there's a big gap.
Worth probably saying in terms of the very first one you talked about, Kibani, the additional funding solution, in terms of that contingent asset.
Yes,
Yeah.
sorry. And yeah, coming back to sort of John's point as well, the additional funding solution does have an application. That's the other thing that we're looking at for the DB-DC hybrid schemes. There are schemes clearly where the contributions are continuing on the DB side, but there is that question mark, and you can bespoke the additional funding solutions depending on how you position the triggers so that the money actually goes back to the sponsor to fund towards DC. But that, again, that's sort of a 2.0. But if a big enough pension scheme came along and said, can you please look into this for us now, then we would.
But just the other end of the scale, because the additional funding solution, there's no, it's not 300 or
No,
200
it's £3 million minimum. Sorry, yes, it's only a £3 million minimum in terms of contribution into the additional funding solution.
Cool, awesome, thank you.
Thanks for that. That's really good. There's comments in the chat. John H, do you want to make your point, John H?
Yeah, thanks. I wasn't intending to speak, but thank you. Just
why not? Come on, John. You can.
You hear me okay?
Yeah.
And I think everything that's been discussed is absolutely in the right direction and fantastically positive in terms of supporting the need to invest. But at the core of this is even the language is about risk on and risk off. And this is we need to move away from this presumption that investing in basically a bankrupt set of gilts is risk-free. It's not. So the whole language of the actuarial profession, the regulator, is what causing the problem. And even the language that trustees could go to jail if they take risk on. I think there's less risk in investing in a diversified portfolio of quality assets. And I refuse to call them growth assets. They're just assets. So I think there's less risk in investing in a reasonably diversified portfolio of global assets than there is in investing in UK government gilts. And so we need the profession. I mean, the professional model assumes that gilts are risk-free. At some point, the profession must say they're not. UK gilts are at AA- rated. They're just above what's acceptable. So we need the profession to redefine the language of risk and hence the regulator. But I'm hugely supportive and encouraged by the product development and the thinking that's been relayed here today.
Thanks, John. That's a good point. That's a good point. I think following off that, a fairly simple comment would be to do with, did I see with profits in one of the slides? Is this a new version of with profits? I'm just thinking in my head in the 90s, noughties and 10s, with profits has been an interesting journey for some people. What happens when it goes wrong, or is there a downside here? I mean, Russell, you're talking about exit strategy or liquidity, you could transfer out and move to another player. What happens if the markets are not right for that? Are there, in the old days, you call them market value adjusters, you call them whatever, are there adjustments within the product that you think need to be there to protect you as an insurer?
That's a great question, and I think that you're demonstrating kind of as much knowledge about general with profits as I probably have. So kind of we're using the with profits fund, but this is a specific kind of policy that benefits from the solvency strength of that, without having kind of nearly what you might call as some of the features of traditional with profits. So there's no market value triggers. We have M&G has a very well-known product called PruFund that has sort of like some kind of corridors, and kind of if values move outside a range, then there's kind of like resetting of kind of the expected growth rates and all of those things. This is not. This is a as Kibani described it, you're guaranteed holding the policy to term to receive the initial guaranteed cash flows. And then what happens is, you've just got a pot of assets that are specific for this pension scheme. So it's nearly like a product for the scheme where it is managed and tracked separately to everything else in the with profits fund. So you're able to look at this and you say, okay, well, I know what I've got. Pension scheme upfront has agreed a sort of set of investment constraints and objectives in terms of investment grade fixed income instruments. and then that pot of assets is tracked and managed purely for the benefit of that one pension scheme. And so if things go wrong in that asset portfolio, if it falls below a certain kind of level in terms of kind of the defaults and downgrades and all those things, then the with profits fund starts picking up the tab and ensuring the guarantee level are met. But there's no other, if you like, nearly not contamination, but you understand there's no smoothing, or there's no kind of like, oh, if this other product within the fund does badly, then there's some read across here. It's specifically linked for the scheme and to the performance of a pot of assets that have been agreed in terms of the constraints and objectives with the trustees.
Okay, thank you very much.
So hopefully that clarifies. I mean, I'm sure we could do more on that, but kind of just to be clear, you're absolutely right. It's kind of like nearly a little bit, with profits policies, that has a bit of bad rep maybe in the market. The key thing, it's the with profits fund writing it, but you really need to look carefully at, well, what is the actual policy that's being provided? Don't be put off.
Okay, thanks for that. Henry, you've had your hand raised, and then we'll come to Bob. Henry, you want to go first?
Yeah, thanks very much, Steve, and thanks, guys, and Swani Gabani. It's great to hear that this stuff's out there. You did sort of mention there's a market for this. Can you expand a little bit? I mean, who are your principal competitors in the capital back journey space?
I mean, I think the one provider who's done some capital back journey plan is Aspinall Capital. I think they've done one transaction. I'm not sure whether it's two yet or not, or whether it's just one. So that there was also the Institute of Faculty Actuaries did a paper, capital back journey plans, and I think they talked to a number of providers that are looking to source transactions. We haven't done one yet. So kind of there are a number of people who are clearly interested in that space, putting forward suggestions and ideas, and there seems a bit of industry recognition that, oh, that's something of interest and something that's helpful and fills a gap that's not in the market at the minute. So I mean, I can only really probably refer publicly to the one they've known and done a transaction, but I think there was a helpful paper written that kind of, and I'm pretty sure at the back of that there's credits of different people that were talked to. I just wouldn't want to single out one or two at the risk of forgetting about others.
And
I think just to add to that, I think the features of sort of the capital back or the insurer back journey plan that we're working on versus sort of a more standard, albeit they haven't been around that long, capital back journey plan are quite different. So I think they're not, I wouldn't say that they're not directly comparable, because the other ones provide a capital buffer and no real guarantee, whereas this comes with an insurer back guarantee, so that they're quite different products, and you may have different objectives, right? Whereas this one is sort of, you win out in terms of flexibility on the optionality to just, we can hand you back the assets on day two if you liked, if you changed your mind, or if insurer comes knocking, or you can ask us for a price. You're not locked in to buy out on the Pru side, but if you asked us for a price, we'd provide you one. So I think it depends on what your objectives are, I think.
Could I just ask why you think this market hasn't developed further? Is it just too early in the cycle, or are there big barriers to entry for others than yourselves?
I think it is a difficult ask for trustees to give away a lot of their assets, isn't it? Really, you can say, trustee, look, I want you to give you all the assets. I'm going to invest this way, and I'll give you some capital to support it. I think that's challenging, but I think the main thing is just it's the level of maturity of the market. So kind of, and it's been great to see over the past 5 years, a lot of innovation, with super funds coming, and then people thinking, oh, if we had some third party capital, then we could recreate that sort of profile that the super funds were looking to without collapsing the sponsor covenant. So, I mean, I think there's been a lot of evolution in thinking, but I do think a lot of it is to do with kind of, schemes are more mature. And they have been progressively getting closer to buyout. And so what started as a bridge to buyout has now, as funding level has taken that step change, people thinking about runoff, and they're thinking about, how do we make it safe for our members, but not just give it all away.
Okay, thanks for that. That's brilliant. Bob?
Okay.
Oh, yeah. When you got your hand up, let's go to Bob first. He was up first, I think. Yeah, go on, Bob.
Yeah, thank you. Okay. For Russell, really, I think the idea of a ring-fenced with profits backed by the with profit MG fund is a great idea. But would the ring-fenced with profit fund for a pension scheme would the trustees or the investment advisors of the trustees be able to advise what kind of investment strategy, or is it purely M&G's investment strategy for the with-profit fund that's followed? Is there any discretion over the investment choices?
We're trying to make it as friendly as possible within the constraints that we operate under. So kind of we've created a policy that's both with profits, but also the technical speak of ensures matching adjustment. So therefore we have constraints in terms of what can be invested in. So it has to be fixed income and it has to be investment grade credit or gilts. Could be private assets could be included in there as long as they're the high quality type of ones. So there is reasonable, I mean, there's lots of flexibility within those constraints. And I guess, what we've sort of looked at things like, if you asked us to say, please, can you give us an illustration? Then what we'd probably do is we'd say, well, here is the sort of portfolio we as an annuity writer would be investing in. Let's start at that and see the economics, and then we would flex from that. So that might be here's 40% allocation to liquid assets. And you might say, I don't really want that because I'm really aiming for buyout. And if I get there in 5 years' time, I know that some providers in the market don't take liquid assets. So let's keep it all liquid. Or you might say, actually, do you know what? We are happy. We would like a bit more investment return. Can you skew that more towards BBB and a bit punchier on the investment side? And I don't mind paying the with profits on a slightly higher cost of guarantee for that. Right. So again, we can give flexibility there. There's sort of implications in terms of price of the guarantee charge. And then there's also implications in terms of what the end game for the fund are. But within that sort of box, or you could say as a trustee, you could say, look, I really want to have all the assets here, with a social or environmental tilt. Kind of feel strongly that we want to do good with our money, can't get that in the buyout market. So I want to have that as one of the constraints or the investment guidelines here for these assets. So again, within that box, which is essentially investment grade credit, then we can give good flexibility and we can work with the trustees and they can shape it within reason any way they want, and we will price for that.
Okay. So Russell, fundamentally, it is a bit like the Clara model, effectively, that you're trying to make a return better than what an insurance company would in the meantime, whilst getting closer towards the point where you're going to a buyout ultimately. So it's not exactly giving the trustees the ability to take a investment strategy which could be equity based and looking for longer returns, the kind of thing that John Hamilton is talking about, possibly. But I think it's a great idea for those organisations or schemes which are close to buyout that want to retain a degree of flexibility, and by doing so would retain the ability to provide discretionary pension increases for people in retirement, etc.
That's right. And then I think then the key thing is how much do you need?
Absolutely.
So for a lot of schemes, if they expect return on the underlying assets here, net of costs and all those things are getting to around the gilts plus 100. Then my question is always, and you're getting diversification and you're getting like a nice spread, all the single name concentration issues, all of those dealt with. I always say, look, do you need the equities? If you need a bit more, then it's probably not efficient to put it in this product. Being honest, it's better to keep this clean in terms of credit. That will minimize the cost of guarantee. I'm sure there's other stuff we could do, but for now we're focused on, let us do let's draw a parallel between what we do on the annuity writing side versus kind of offering something to a scheme that's directly comparable and where they can get the same sort of strategy. And, therefore it becomes a little bit easier to kind of people say, yeah, that's what a annuity writer does. Therefore you can transfer those assets easily if you want to.
Okay.
There's no reason why you couldn't do a combination of an SPP with an additional funding solution, where you then use the additional funding solution to invest in underlying equities or, whatever risky assets that you wanted to. So you could always use it in combination.
I don't regard equities as being risky assets, and on the lines of what John Hamilton was saying earlier, by the way. Okay.
We'll come to John in a minute. Ed Charles, you had your hand raised. You go first, and then we'll come to John.
Oh, thanks very much, Steve. Yeah, thanks for the all the new ideas. I definitely echo the positive sentiments expressed on this call of the sort of broadening of mindsets of all of the participants in the pension world to think about quite a number of interesting new options, which is very exciting. The question I've got is, how do you think the community of intermediaries, the EBCs, the law firms, the actuarial firms, etc., will deal with these various new options, given the You know, I mean, up until now, broadly speaking, they've been gradually shepherding everyone through the sort of relatively homogenous buy-in, buy-out gate, and now all of a sudden there's a lot of different ideas on the table here, which are credible and provide considerable additional flexibility. How do you think the intermediary community is going to cope with this complexity?
It's a great question. I was going to say there's a second mover advantage in the pensions world, and I do think that one of the problems with the Clara have had in terms of the speed at which they've been able to execute a transaction has been because, you know, it was new. And if you set yourselves up to compare against a buy-in and say, look, this gives you more upside, etc., the problem is, you know, kind of 5 years ago, frankly, no one really knew what buy-in providers did. You know, kind of a handful of consultants had really drilled below the kind of the surface to see how all that works. And it really was just kind of, well, everyone goes for buying and its cheapest price wins. We don't need to know what sits beyond underneath the bonnet. So I think that kind of 5 years on, people having contributed extensively to Superfund consultation, you kind of, there's a better knowledge of the risk and reward you take if you move to buy-in provider, which really helps you then compare against the other solutions as well. So I think I'm more comfortable now about having new products launching than I would have been 5 years ago, where, well, I mean, I kind of tried to launch a couple when I was at Legal & General, and you realize quickly that actually, gosh, you know, kind of you try and recreate a buy-in on a scheme's balance sheet, and you realize no one really knows what sits behind the scene in a buy-in, and therefore it's very hard to convince people that this is better or kind of or worse or whatever or cheaper. So kind of yeah, feels a little bit easier now, Ed.
And having worked on the other side of this, you know, as an ex-investment consultant on the trustee side, definitely, I think my experience now going out and speaking to EBCs, they seem to be asking the right questions. They seem a lot more clued in. Having said that, I think with any of these products, you know, referring to the Clara transaction and how long it took, I would say lead time on this is anywhere between 12 to 15 months, because it will have to start off as an education piece where lawyers, EBCs, trustees all try to get into the thick of it and understand what the product and the features mean.
And I think the economics are going to dictate to a great degree, because the economics of some schemes are extraordinary in terms of outliers and excess capital and surplus, and therefore the consultants will be dragged along to some degree by the trustees and sponsors.
Okay.
I think it's also worth highlighting there is an obvious conflict of interest here for some consultancies, because they do end up losing a smidgen, shall we say, of control. So it will, you know, some of it will depend on the trustees pushing this forward.
Okay, thanks. John Hamilton, you're next, and then we're going to Professor Bromwich. But John, you go first.
Yeah, thank you for the opportunity. Just coming back to Henry's question, is where is the market on this and what's happening? You know, from a trustee perspective, a lot has changed in the last 18-24 months. The move towards self-sufficiency has made trustees realize that we end up holding a chunk of assets which is very similar to an insurer. And then when we do the buy-in, we say, well, actually, we're giving you all the same assets. What are you going to do with them? And the answer is take a huge profit slice. So I think trustee knowledge is no longer that moved on from a buy-in as a black box. They understand there's a sort of finite number of assets you can invest in. So I think the trustee, certainly the informed trustees, are becoming much more knowledgeable. There's one allocation of capital and who's going to manage it. On Bob's point, I mean, the issue about holding credit rather than equities, you'll sense I'm a big fan of equities, diversification and growth, but equally credit is a source of productive finance as well. So I'm from the world of anything's better than gilts. So if we invest in the market through credit, I think that's good as well. The big unknown in all this, which I'm finding, and I've been through the look recently on buy-in and looking at all these structures, they're all attractive, is for trustees to truly understand the pricing. I've seen 20, 30, 35 basis point differential on prices on a buy-in, which is not really, these are big numbers. And so, on all these products, I think trustees will want to have a greater understanding, and I think it's good, an open understanding of where people make their margin and what the price is and what the profit allocation. And I think once we have an open understanding of that, then I think these products have got a real place. As I said in my chat point, the key thing we must change is the regulatory remit. Anything that basically defines risk as being a criminal activity, if you go to an extreme, is just silly. And Gurbani's reference to risk, again, we keep calling investment risk. We need to change that whole mindset. But very, very, feeling very positive about the options for informed trustees going forward.
Thanks, John. Professor Bromwich, do you want to unmute and say your piece, and then we'll wrap up. But I'm not sure if you.
Yeah.
Here we go.
I think I'm with you, aren't I?
You're with us. We can hear you.
Good. It's really quite good to hear this sort of thing because, you know, the days when trying to carry on were all looked at with great wonder, and really you can't do that sort of thing, have now gone, and now we've got lots of alternatives, so we can in ways of running in. It's partly because the world's changed a bit. The point I want to make is simply this: pensions are risky. Everybody agrees that, I think. Even in the industry, everybody agrees pensions are risky. Listening to the presentation is probably me, but as far as I can see, you are promising the sponsor, the scheme, and everybody no risk. And so you bear the risk, but your risk seems to have disappeared anyway. So I'm really worried about quite where the risk now lives, or does it, or have you managed to find a way of getting rid of risk entirely?
So the
Good luck.
I think, yeah, thank you. So in the particular kind of I guess the capital back journey plans, then I guess the person, or buy-in for that matter, the person providing the capital is bearing the risk, and then you say, well, how much is it? Is it forever? So I think it's a good question. Is it because we talk about price and all those things? Quite often we don't talk about, well, how much capital do insurance companies actually hold, and kind of what would it take to break the insurance company itself, right? So that's kind of, and maybe we'll start to see a little bit more of that. I feel that kind of probably consultants and trustees have hidden a little bit behind well, it's all protected by the FSCS, so therefore we don't care. It's the cheapest price that matters. I see from recent surveys that for certainly in the buy-in market, there's a little bit more focus, not just on the price, but also the member experience, the administration, the various aspects that are kind of a little bit softer, but still very important. I mean, from our perspective, kind of, the way I think about it, if someone asked me that question, like how well protected is, so I talk about, well, what's the solvency ratio of our with profits fund? About 300%. I talk about then what sits behind that, which is Prudential Assurance Company, UK, which is AA rated, and has a solvency ratio itself about 200%. And then behind that, I would talk about FSCS protection. Right, so again, I would say there's 3 different layers, and you should look at all of those. And last of all, you should think about the assets themselves, and can you get the assets back? Right, so eventually, kind of, do you have, is it like a secured bond, or is it an unsecured bond? So kind of here's certainly for the with profits policy, you have multiple layers of covenant protection, and also you have the ability to take your assets back whenever you like. So kind of that in some ways, I don't want to say gold standard, but I can articulate it like that. And then we can talk about, well, what does 300% solvency ratio actually mean? And how do you count a 1 in 200 year event? Does that mean you can have 3 1 in 200 year events in a row? I mean, kind of, I don't know about you, but I'm old enough to have lived through at least 3 1 in 200 year events at this point, all right? Kind of, and I'm not 600 years old. So kind of, I think, kind of it is important to look at the different layers of protection and not just say, hey, it's okay, we've got Solvency II and it's calibrated to 1 in 200 years.
Okay, I think a great answer, Russell. Brilliant answer. Okay, it's now nearly 11:40. Fantastic presentation, Russell. Thanks to you, thanks to Gabani, and thanks to JQ. Thanks to everybody for your questions. Really enjoyed that. Presumably, can we have a copy of the slideshow, and would we can send it off to people if they want to have a copy, which is great. Good debate. Hopefully you've enjoyed the presentation, and hopefully you've enjoyed the questions. Thanks everyone for participating. The video of today will be up later on. And thanks again to Russell, Gabani, and JQ. Next week we have a young panel on the heading of why do the young hate pensions? So if you're underage, I don't know, 45, 40, I don't know. Why did the young, JQ, this is your territory. If you're under whatever, then please encourage anybody you know who is a youngster, 18 to 50 maybe. Why did the young hate pensions? That's next week. So that should be a really, really interesting session on pension playpen. So thanks again to M&G and the team. Thanks for all your questions. And as usual, let's pray for peace in the East, and let's pray for peace in the Middle East. And let's hope we get a new pensions minister soon. So congratulations to Laura. See, it's on record now. See, there you go. But, so thanks everybody. Really appreciate your time and your input.
Thank you.
And the video will be posted later on. So enjoy the rest of your day. Thank you very much indeed, everyone. Take care.
Thank you.
Cheers. Bye.
Thank you.
Bye.